In Chapter 10, I've kind of gone through and highlighted Chapter 10 and 11 on this overview sheet. I'm going to go through it real quick and then we'll start and we'll work a couple of exercises in this recording. The main thing, if something's going to be categorized as property, plant, and equipment on the balance sheet, the asset has to have three characteristics. It has to be used in operations, and the key word there is used. It has to actually been used. So if we have equipment that's sitting idle, that equipment will not get categorized as property, plant, and equipment, because property, plant, and equipment are used to generate, like operating income. So it has to be used, and it's going to generate operating profits then. So we want to think of it, as core, it's assets that are used in core operations. So it has to be used. If it's sitting idle, it's not PP&E. And again, I'm going to abbreviate property, plant, and equipment, PP&E. It also has to have physical substance, obviously, and it has to be long-term, or it's not going to be in the long-term category of property, plant, and equipment. And really, all property, plant, and equipment is depreciated, except for land. And of course, because it has unlimited life, so land doesn't get depreciated. Key things about when we acquire property, plant, and equipment, we're going to record it at cost. Well, cost is easy if we pay cash. But what if we don't pay cash? If we don't pay cash, then we have to determine the cash equivalent price, which really is looking at fair value. So back in Chapter 2 on the conceptual framework, if you want to turn to page 57 of your textbook, Chapter 2, that chapter went over the three levels of fair value. So if there is an identical asset, and we know the market value of that asset, then that's the level 1, and that's the highest priority. Or maybe if there's a similar asset that we can, and there's a, like a used car market value. So like the Blue Book for used cars. It's not as reliable as if we were, if it had been stock, like up here, identical asset. If there had been stock with a market value, again, that would be very reliable, wouldn't it? Using the stock price when if it's publicly traded stock. If it's publicly traded stock, using the market value, very reliable. Second would be kind of a secondary market for like used cars. And level 3 is when we really don't have a market. So if we don't have a market, well, then what can we do? Well, if we think about these assets are being used to generate profits, well, really, to begin with, revenue is going to come in. And if revenue comes in, that means we're going to be collecting cash. So cash receipts will come in. So that's why this third category, it doesn't have to be what I've written here, but a common data that's collected by a company is to project these future cash receipts that a piece of equipment or whatever the PP&E is will project what we think those future cash flows will be and discount it back to the present value to figure out, what's it worth today. So again, if this is, time value, we're looking at those cash receipts in the future. How much is it going to generate down the road? Dollar. But that's all in the future, and here we are today. How much will it, what's the value of that today? So we have these three levels, and we're going to see in Chapter 10 how we use these concepts, these three concepts, very often. Also, in terms of cash price, it's not going to include costs for inefficiency or anything that was unnecessary. So let's say that I buy a computer, and I'm carrying it up to my office, and I drop it, and I didn't insure this computer, so I have to go back and buy a second computer. Well, and I'm going to, so the first computer, do I capitalize the cost of that computer and record it as an asset? We're going to expense the cost of that first computer. It'll only be the second computer that will record as property, plant, and equipment. So if there's inefficiencies, if we make mistakes or do something that's unnecessary, we expense those costs. We don't capitalize them. Moving on, it's going to include all costs to acquire and get ready for its intended purpose. That could almost really be in quotes. That's right out of the accounting standards. We saw this same cost principle when we were studying inventory. So it's the same cost principle, except now we're applying it to property, plant, and equipment instead of inventory. When it was inventory, we said all costs to acquire and get ready for sale, because we sell inventory. That's its intended purpose. So here with property, plant, and equipment, it's everything to get it ready. So everything to buy it, get it to our place, and get it ready to be used. So purchase price, freight, if we insure it while it's in transit, all of those costs we will capitalize as an asset. Sales tax, if we have to install it, if we have a trial run before we actually start using it. So you want to just sort of think of the time chart. Is this when, if this is the point in time when we start using it, all of these expenses, generally speaking, all of these expenses, if those are dollars, all of these expenses are, excuse me, I shouldn't say expenses, but all of these expenditures, up until the time we start using it, we will capitalize as a cost of acquiring the asset. So all of these costs get capitalized unless it's an inefficiency or unnecessary activity. So if we have a trial run before we start using it, we will capitalize the cost of trying the trial run. Land. The unique thing about land, it's going to be its cost, but it can include a lot of things because land is going to include all the cost to acquire it and get it ready for its intended purpose. What makes accounting for land a little complicated is that usually we buy land to construct a building on it, or we buy land that has a building on it. So we have to differentiate how much of our cost belongs to the land and how much belongs to the building. Well, if we acquire land and we're going to construct a building on it, the land cost will include all costs to get that land ready for its intended purpose. If the intended purpose is to construct, a building on it, that's going to include clearing the land, grading the land, any filling, if we have to pay any back taxes, special assessments for like curbs and gutters. If there's permanent landscaping, like putting in trees and shrubs that we intend, to use forever, all of those get capitalized as land. And those are not a cost of the building. Those are all cost of the land to get it ready to construct the building on it. By the way, just a reminder, we don't depreciate land. And if there are land improvements that have limited lives, like sidewalks, that sort of thing, we depreciate those. So we can't have a land improvement account that gets depreciated. I'm going to skip over this next part. Lump sum, we'll see that in a little bit, and cash discounts. Let's go ahead and move on. Let's go ahead and look at exercise 13. And I want to, before we get there, I want to talk about this component. If we exchange debt or equity for property, plant, and equipment, so instead of paying cash if we borrow money or we give up stock, we're going to record the new asset at, quote, the fair value of its fair value or the fair value of what is given up, whichever is more reliable. And we're going to look at that in exercise 13. Do I use the fair value of the debt and equity, or do we use the fair value of the property, plant, and equipment? And generally, unless there's a secondary market for our debt, generally then the fair value of debt is the present value of the future cash flows. So let's go look at that right now. Okay, exercise 13. So here we have on July 6, Zonker Company acquired the plant assets. And so Zonker's acquiring these three assets. So we're going to debit those three accounts. And in exchange, they're going to give up 12,500 shares, $100 par value common stock. And the stock had a fair value of $168 per share. Okay, so we have kind of a fair value here, right, for the stock. And we have a fair value over here for these assets because this is their appraisal value. Well, keep in mind we have determined which fair value is more reliable. What's more reliably determined? Well, here's the key thing. This stock is publicly traded on a stock exchange. That's going to be very reliable, right? I can go to July 6 Wall Street Journal and look to see Zonker Company, what was its stock selling at on that particular date. And we'll know the market value, which is in essence its fair value. Appraisal value. Well, if you've ever had anything appraised, that's rather subjective. Appraiser A may give us a different dollar amount than appraiser B. So this is much more subjective than the stock market. So since that's the case, we're going to go with the fair value of the stock. So what's the fair value of the exchange? It's going to be the stock. So there are 12,500 shares that are given up And that going rate, the market price, which becomes its fair value, is $168. So we're going to record this transaction at $2,100,000. That's the value of the exchange. So let's record the common stock at the $2,100,000. Remember, par value, which is $100, goes into the common stock account. So that's going to be $1,250,000. And then the difference, right? These two paid in capital in excess of that. So $2,100,000 minus the $1,250,000 is $850,000. So we've recorded the stock being issued. So we're recording that at its fair value. Now, second part of this problem is actually a different accounting issue. We have to take this $2,100,000 and divvy it out among these three assets. Well, how do we do that? Well, we're going to just use this appraisal value, listed down here, and we use the relative fair value approach. So we actually did this back when we were in chapter 7 and 8 with inventory. We saw the same concept, because if we buy several assets for $1 amount, if we bought each of these separate, it might cost us $2,400,000, and I just say land is 4/24 of the total, building is 12/24 of the total, equipment is 8/24 of the total. And so then I take those fractions or percentages times my actual cost, right? Fair value becomes the cost, and then these are the assigned values. So let's just take these numbers and put them up in our journal entry. So the land will get assigned a cost of $350,000. The building a cost of $1,050,000. And equipment $700,000. Okay, so we got through all of that. Now I want to do what if. So remember, the key here is that when we have an exchange, we're acquiring property, plant, and equipment in exchange for something. We have to determine fair value in order to measure it, and we have to figure out which fair value is more reliable. So let's do a what if here. Let's say the stock is not publicly traded, so it's not sold on a stock exchange. The owner believes the stock to be worth $175 instead of $168. These same assets, so these assets could be purchased somewhere else. Just kind of let your imagination go with it. Let's just say somebody else is offering us three similar assets for $2 million. Well, which is more reliable? This stock price of $175 or the $2 million? Well, the owner, believes his or her stock is worth $175. That's not very objective, is it? It's really quite subjective and kind of their own opinion. So because of that it's subjective, that makes it less reliable. So in this case, if this had been the scenario, we would record the transaction at $2 million. So instead of this $2,100,000, we would be using $2 million here. So the stock would be priced at $2 million, and we would allocate the cost. These three debits would total $2 million. Okay, now the next scenario is that the company expended the following amounts in cash between July 6 and December 15, and really we're to determine, if you add all of these up, you're going to get $541,000. So cash is paid of $541,000. How much belongs to building, equipment, land improvements, and cash? So, this is really just a good application of, the cost principle. All costs to acquire and get it ready for its intended purpose. So the cost principle, we're going to capitalize all costs to acquire these assets and get them ready. So if we're repairing the building, again, we haven't started using the building. This is still getting the building ready. So that means that we want to capitalize the building. That's part of the cost of the building. Construction of bases for equipment to be installed later. That's actually going to be equipment, or the equipment. Driveways and parking lots, that has to do with the land, doesn't it? So that's land improvements. And those are temporary in nature, so we'll end up depreciating them. Remodeling of office space in the building, including new partitions and walls. That has to do with the building. That's adding to value in the building. And then special assessments by the city on the land, like curbs and gutter, that kind of thing. And that's a cost of the land. So we're going to add the $105,000 plus this $161,000 for the building. I add that plus that. So the building's going to have a cost of $266,000 of these expenditures. Equipment, the $135,000 will go here. And then land improvements, that was the $122,000. And then lastly, the land for $18,000. All right, so there's an application of the cost principle. Last one, we have a company. They bought equipment for $260,000. And then they also paid freight of $10,500. So they've got two expenditures, buying the equipment and then the freight. Now, they also paid early and they got this 2% discount. We saw discounts when we dealt with inventory. Discounts reduce our cost. Discounts reduce the cost of whatever asset is that we're purchasing. If it's merchandise, it reduces the cost of the merchandise. If it's equipment, it reduces the cost of the equipment. So really, our cost for the equipment is only 98% of the $260,000. That's $254,800. And then we're also going to pay the freight $10,500. So if I add those together, you're going to get $265,300. For that. Okay, now we want to move on to exercise 14. Here again, we're going to have an exchange, except we're not going to give up, stock for equipment. We're actually buying equipment with this note. So let's read through it. Chippewas Inc. has decided to purchase equipment from Central Michigan Industries on January 2, 2014. Blah, blah, and then kind of goes blah, blah, blah. They are issuing an $800,000 5-year, zero interest-bearing note for the new equipment when the prevailing market rate of interest on this obligations of this nature is 12%. The company will pay off that $800,000 in $560,000 installments. So we have to figure out what's the cost of equipment. And again, in accounting, in substance, there's no such thing as zero interest. We know in true economics, time is money, and time is actually in terms of interest, right? So let's kind of draw this out a little bit. So here's year 1, here's year 2, here's 3, year 4, and here's year 5. And you know what? Let me go up and kind of erase some of this. So it's kind of out of our way. And then I can, oh, sorry, I got a little too carried away. Like that. Okay, so year 1, year 2, 3, 4, and year 5. And so what's happening is, I'm going to drop off the thousands, but there's $160,000 paid at each year end. So that makes it an ordinary annuity. If you add that up, that's where you get your $800,000. $800,000 is not here today, okay? The $800,000 gets paid, $160,000 each year for 5 years. So when we go down to use our calculators then, we know the payment is $160,000. Number of years, 5. Prevailing interest rate is 12. Future value, 0. Because remember, if we have a future value, it'll be a big lump sum. And if we have a present value today, it'll be a big lump sum. And we don't have any big lumps in the future. The $800,000 is an annuity payment. Remember, annuities are equal multiple payments in the future. So equal multiple payment, we put that annuity in our calculator. And we want to solve for then the present value. So when you enter all of that into your calculator, you're going to get something like $576,764. Now, I am having you use your financial calculators. When you go to do this on Wiley Plus, it uses the time value of money tables. And if I had used the tables, as a matter of fact, the tables aren't as accurate as your calculator. The tables would have given us a number of 576,765. Not a real big deal, is it? The only difference is $1. You and I recognize that is very immaterial, very non-significant. Wiley Plus, on the other hand, sees that it's looking for a 5 in this digit, and it's going to count that 4 wrong. So when you do your homework in Wiley Plus, for this Part A, you're likely to get it counted wrong. By the way, this is a part level submission assignment. So Part A, you're likely to get it wrong because you may be off by $1 or $2. Go ahead, submit it, get your initial answer, and then try to, like add $1 or subtract $1. Maybe you'll get lucky and you'll get it right. But if you don't, your instructor will go in and adjust your score. Because, after your third attempt, Wiley Plus will show you the answer is 576,765, and then you can go on and do Part B and C. So just go ahead and, keep going in Wiley Plus. It's just, trying to work a system and make it work for our purposes, right? So how do we manipulate it? I still want you to do this assignment because you'll see in B and C there's some good applications that you need to know what you're doing. And by the way, this little exercise, we saw this earlier. When we were in Chapter 6, we did similar things like this. Okay, then the difference between the equipment and the $800,000 is what we put in the discount, $223,235. So what do we have going on here? So that means we got a present value of $576,764. So in the future, we have total payments in the future. Our total payments are, that's supposed to be an S, our total payments are $800,000. We're really borrowing $576,000, I'll put 765 so it agrees with the Wiley Plus number. That's what we're really borrowing, that's our principal. The difference between what I pay back on a loan and the amount I borrow, the difference, do you remember what it is? It's interest. So my payment is either going to be a principal payment or interest. So this discount on notes payable represents future interest expense. Okay, let's go to the next page. Actually, we're going to go not only to the next page, let's go to the one after that, and let's go to notes payable and post that $800,000. And then the discount is a contra liability. And let's put our $223,235 in there. And I also want to make a note, just for reference, this represents future interest. Okay? It represents the future interest. So we took the gross amount of the note, we discounted the interest out of it, so that we have, our principal amount of the 576, whatever it was. Okay, so there we go on that. Okay, so now we said, the present value is 576, 764, well actually 765. So I've plugged it into this table. So here's our loan amortization table. So we start with this balance. Our interest rate is 12%, so 12% of our balance, of our principal, is $69,212. Here's our cash payment. So if we paid $160,000, if $169,212 is interest, then what's left over is principal. So of the $160,000, part of that's going to be for interest, the rest is for principal. That reduces our balance. So we started with 576, subtract that by 90,000 to get your remaining balance. Okay, so now let's make our journal entry. So for 2014, cash is paid, $160,000. So let's put that in our credit. And what's going to happen is we will debit our notes payable for the full amount. Now let's go post that note payable. So the note payable, I'm going to post that debit of $160,000, and that will leave us a balance of $640. So the note payable represents all those future cash flows. Okay? All the future cash payments are in this note payable. This does not really represent the true principal of the note. It represents those future cash payments, just because of the way it's set up. Okay, then we also have interest expense, $69,212. And then we're going to reduce our discount on notes payable once we recognize that interest. And let's go post that. So we've posted that. Let's post this to the discount. So that credit, $69,212. And so that will give us a debit balance now of $154,023. So these two, let's go up to our balance sheet. I want to know, what goes on the balance sheet. At the end of 2014, we would have $640,000 less the $154,23. It's a negative because it's a contra liability, and that gives us a carrying value or a net value of $485,977. Okay, that $485,977 is our real debt at the end of 2014. There we go. And so my balance sheet should agree with this loan amortization schedule. The net of those two accounts is going to equal my net balance over here. Okay, the other thing is depreciation. So 10-year life. So we said the cost of the asset was $576,765, and no salvage, just divided over 10 years. So that's going to be $57,670. We'll round up to 7. $57,677. $57,677. Let's go put that on our balance sheet. So over here, we would have our asset account at cost, $576,765. We just depreciated $57,677. It's a contra asset, so put brackets around it, for a book value, accounting book value of $519,088. Then what will we, so we'll have assets on the balance sheet, debt on the balance sheet as well. When we go to the income statement, if I've got equipment on the balance sheet, what's related income statement account? Well, depreciation expense. So let's record. We would have depreciation expense down here. Go back to our journal entry. Depreciation expense was this $57,677. The other thing, if we have long-term debt on our balance sheet, well, what's related account on the income statement? Well, if I have debt, I have interest expense. So let's go back. Look to see, what did we record? We recorded $69,212 for interest expense. Okay. So we're finished with 2014. We can go back and do 2015. And we've got this chart. So $485,977 at 12% is the $58,317. Subtract it from our cash payment to get our principal payment. So we can record now this $160,000 as our cash payment. Record our interest expense for for our 2015, $58,317. And then lastly, we would have depreciation expense. And it's going to be the same calculation, right? It's our same original cost over 10 years. So $57,677. So I'm going to go ahead, this time I'm going to go backwards. I'm going to have us go ahead and do our interest expense and report our depreciation expense on the income statement. So let's go to the next page and go ahead and report on the income statement these two expenses. So depreciation expense, it was another $57,677, and interest was $58,317. Looks like I need to post to the note payable and the discount. So let's post the 160 and the 58,317. So the debit to notes payable, 160. Draw our line, and that leaves us with 480,000. And then we had a credit to the discount of 58,317. That gives us a debit balance of 95,706. Let's go ahead and take these two numbers and put it in the debt section of our balance sheet. So 480 and 58,317. And that gives us a net amount of $384,294. And then let's go back and see, does this agree with our loan amortization table? And it does. There's our $384,294. So those should always agree. If they don't, we've made a mistake. On the balance sheet, the cost doesn't change. We only debited the the equipment once for $776,765. However, accumulated depreciation has grown, right? We went from $57,677. We added another $57,677. So that has grown to $115,354. So we have an annual expense of $57,000, but we have accumulated both of those to $115,354. So that nets to $461,411. $461,411. Okay, so that's a good taking you all the way through the loan and the equipment itself. So this is a really good exercise. Even if we only did the 2 years and didn't go all the way through the 5 years of the loan, you get to see the idea of what's going on with the account. So it's good for that reason.